Good morning. My name is Nicholas O'Connor, and welcome to day 2 of the Latin American Virtual Forum, with content produced by BlackRock and support provided by the team here at Bloomberg Linea. Yesterday, we had a few technical gremlins during the course of the morning, but I'd just like to reassure everyone that we're fully plugged in and ready for a great morning of content today. Yesterday's content was stellar, and this will continue throughout our second session. Once again, I am here in our studio in Mexico City, and I will be connecting with speakers based all across Latin America and the world. First off, we're going to Atlanta, where Ross Naver, Chief Client Officer for Latin America at BlackRock, will be giving some opening remarks. Good morning, Ross, and over to you.
Nicholas, thank you, and welcome everyone to day 2 of the 10th anniversary Latin America Investment Forum. We had a wonderful session yesterday, and we had a lot of engagement, including many of you reaching out about the materials, which we will be making available on our website, via email, and on the YouTube channel. So today, focus as much as you can, really be thought-provoking and try to take down notes. Don't worry about getting the materials. We'll make sure those come to you. Today is going to be about democratization of investments, and we have a very good agenda ahead, as well as an opening and engaging conversation. To quickly recap yesterday, I want to go through a couple of the key topics. Yesterday was about markets. We opened up the day with Dominic Rowe providing an overview of what we're seeing in Latin America and his purview as the head of Latin America, and his engaging conversation with Larry talking about his view on markets, which had a couple of very consistent and important themes: growth of the capital markets and capitalism worldwide, the long-term views on sustainability, and the realities of transition finance that are happening today, and the importance of being invested along with the companies and the organizations that are driving decarbonization. The biggest takeaway, and for my opinion, was his shades of brown, dark brown to darker, lighter dark brown, et cetera, as we think about the shape of moving to a green economy. Following, Wei and Axel talked about markets with more of a geopolitical tilt. And this, quite frankly, this session, the biggest takeaway for all of you is we're here for you. These are the conversations we want to have with you. We want to hear about what you're thinking, provide our insight on what we're thinking, because the one big takeaway in that session was it's going to look very, very different in all the regions. And then finally, Cindy and Rick went through a markets overview about staying invested. I think Rick's takeaway was very much simply, rates are going to go higher. How much higher? Maybe not as high as people may think, but the duration of how long rates will be high is certainly something that we all have to keep in account. Now, in addition to those presenters, we had 2 special guests. We had a barking dog, which we're still trying to figure out where the barking dog came from, and we had a quacking duck. And if everyone was in the Larry session, the quacking duck was actually Larry's cell phone, and he said it was Mr. Capito. And that's who I'm joined with today, Rob Capito, president of BlackRock, and we're going to have an open dialogue here on democratization of investments. So,
glad to be here.
Excellent, excellent, excellent. So let's get into it. Let's talk about clients. Let's get into what you have the opportunity to do every single day, is talking to clients, unexpected challenges. When you're talking to these leaders in the public and private sector, what are clients and the ecosystem partners thinking about the environment today?
Well, I think there's a sense of accomplishment from the last several years in their investment portfolios. Everyone has gotten bigger just because of the market appreciation that they have in their portfolios. And I think they're worried about the next couple of years. And what they're worried about is inflation. And I think it's pretty obvious that because of everything you've all read about, supply chain interruptions, the war in the Ukraine, the differences of pricing power now that we're coming out of COVID, expenses rising, where should we be investing at the moment? So the last couple of weeks, I've been talking to all of our portfolio managers and stressing our portfolios to what is called scarcity inflation. What does that mean? Well, I think we all know that wages are going up everywhere. Why are wages going up? And the real answer is we have a shortage of laborers. So just in the US, 11 million people went out of the workforce during COVID, and 8 million people came back in. So we have a shortage. So wages are going up because of those shortages. What does those shortages mean? Well, I think we may have food inflation because many of the laborers that were working in the farms want to go to construction. And it's pretty obvious to look around every country and you start to see all this construction and it pays more.
Mhm.
Well, that means that you can't get laborers on the farm. Not only can't you get laborers, but most of the fertilizers and sprays that you need on a farm come from China. And they've been disrupted. So they're not getting what they need. And when they do, the prices are higher. So food prices are going up, or they're just not going to plant what is really needed. The third thing, which is also obvious to everyone, is energy. And energy prices are going up for political reasons, for war reasons, for many reasons. And that gives you the trifecta of inflation. And then you add one more thing, which is housing. And just in the States, we're short millions of homes. And when you're short and the supplies are short, the prices are going to go up. So people are wondering, how do I look at my portfolio assuming there's going to be inflation? So we put that aside. And now we look at the second thing. Rates are going up. There's no question that rates are going up. And when you look at that and assume that the Fed in the US has to not only raise rates, but they're going to sell some of their balance sheet, it's going to put pressure on the fixed income market and rates will rise. So, what does that mean for equities? Well, we've all been the beneficiary throughout COVID on equities rising. Some of that rise was because companies did well and could pivot their revenue models to take advantage of the opportunity and lower expenses. But some of that was because a lot of companies over the last several years have bought back their stock and raised dividends. So there was less a supply of equities when people wanted them because there were no value in treasuries and very low yields. So equities rose. Well, now we're in a situation where companies may not be able to raise prices as fast as their expenses are going up. And a lot of the pension plans and institutions used equities as a surrogate for bonds.
Mhm.
They went from some 60% funded plans to 95% funded. And when rates get to a certain level, they're going to sell equities and buy bonds and lock in that pension plan going forward. What rate is that going to be? Well, a back of the envelope estimate is 3.5% to 4% would do it. And then when that happens, you're going to see a lot of pressure on equities. So I would take a portfolio. I would use the technology that is available to you, certainly through Aladdin.
I was
If you're
about to say
Aladdin customer.
a scarcity shock scenario. Yeah.
And what you do is you say, what will happen to my portfolio? And what sectors would I want to invest in? So I can give you one example is you may want to look at something that is a bit more inflation proof, like defense. Because of the geopolitical issues, I don't think there's any question that people are going to be spending more money on defense. And when defense companies sell to the government, they sell at cost plus.
Mhm.
And that takes into account inflation. So they're pretty much assured of the margin that they're going to have by the time they deliver that. So there's an industry which may be more inflation proof than if you were investing in another industry that would be less inflation proof. And then the other thing, which would be interesting, would be commodities. That's what I just described to you, is shortages, so that the price of commodities is going to go up. So in general, this is what our clients are thinking about. They're asking us to test their portfolios and give them some ideas that they can continue to earn an above average rate of return. And I have lots of ideas of how to do this. So your question was, what are clients thinking of? This is what they're thinking of. And then they're looking for the solutions, and they're looking to us to help provide those solutions to make sure that they can have the returns that they need. And I could tell you from BlackRock's perspective, over 90% of our clients are retirees. And this environment will make it very difficult for them to retire in dignity. So what we're looking for is returns in various areas, which we can talk about, that could give them that added value that they're going to need. So clients are worried, rightfully so. They've identified the 4 or 5 trends, and now they're looking to put in an action plan to take advantage of that.
You know, what's interesting in hearing you talk about this, and when you're hosting the portfolio managers meetings and you make that open to all of us at BlackRock, you'd always talk about the daisy chain. Follow the daisy. And we're going to go through that actually here. We're going to round out a question about culture. So how do you have this deficit of employees? How do companies think about it? And if you think what we're hearing in LATAM, how can you give us investment advice? How can you give us advice on this idea of transition finance? And then even to the materials companies, which many are prevalent in LATAM, how can you help us think about, is it time for us to now start to expand our operations? So we'll get a little more into this. So a big part of what you were getting into is weathering crises. So obviously beyond your entire career, the last 34 years have been here at BlackRock, obviously founding the firm, and you've weathered quite a few of them. So if you think about the financial crisis of '08, the recent pandemic, looking back, what do you think has contributed most to our success and helped us continue to serve our clients during volatility? And how do we think about pivoting in this new world?
I think the key to the success is being in front of the next changes that are going to occur. So you have to have the themes and the trends. So last time I spoke at this conference, I talked about cash, and I recognized that with 40 trillion of cash that was outstanding, there was 18 trillion of debt that had a negative yield, which I still don't understand how to calculate. And if you follow the cash, it had to find a home because it was doing no good at zero in your portfolio, and you were losing money every day you had that cash. So getting ahead of that trend and knowing that there was that much money that was in the marketplace, you knew that if you couldn't get a return in fixed income, that it had to go into equities. So you had to look at equities that primarily growth equities that paid a dividend to offset the negative or zero yield you were getting in the bond side. You also knew that the government was building their balance sheet and buying all the long duration out of the marketplace. So they were ahead of you. So it gave you more of an idea that you needed to move into other asset classes to give you yield. Many people moved into private credit, and these are good credits, but they don't want to or have access to the capital markets. But the spread that you get is considerable relative to investment grade type credit. The second thing they moved into was loans, and loans from good credits that paid a higher rate of return. And then you saw a dramatic increase in moving into what the market calls alternatives. And at BlackRock, we wanted to make alternatives less alternative. So that included private equity and the private debt that we're talking about, and other tools that you could use to get outsized yields in the marketplace to offset the lower yields. So the success is being able to identify the trends by having portfolio managers on the ground across the world, identifying the opportunities within the North America block, Europe, and Asia, ranking order where we think the opportunities are, then delving into specific investments, and then testing that using the analytics that we built and having some scenarios of what can happen, what could go right, what could go wrong. You must do this. And without the analytics, knowing the risk and return, BlackRock could not be what it is today. And so far in our 35 years, we've gone through 11 financial crises. And we've weathered that because of the risk management that we have. We've never been through a pandemic. And having the whole economy closed really was something that we all had to spend hours and hours talking about what can happen. And I could give you an interesting example. Knowing what we thought was coming down the pike, we called our clients and we said, this is a time to sell bonds, buy equities. And we went out and discussed this with lots of clients, and the clients that executed that trade wound up having a tremendous return. And we called to make sure that people had liquidity. And actually, I made a call to an insurance company. Mm-hmm. And remember, insurance companies would like long duration assets, and we saw there was no yield. And this insurance company insured primarily cars. And so they need liquidity for accidents that happen. That's how it works. So as a client, we offered opportunities to provide liquidity. And the CEO said, I don't really need any liquidity. In fact, I'm calling you to help me place my liquidity. And I said, well, how can that be? And he goes, Rob, there's a pandemic. Everything's closed. No one's driving. There are no accidents. So insurance companies that primarily cover cars around the globe had excess cash. Now, that's not in my playbook. It's my first pandemic, the first time the economy closed. I didn't know that. But now knowing that, I started thinking about other insurance companies and what their needs would be during a shutdown and a pandemic, and then use that for many other industries that we had and factored that in. And then we put that into our risk management system, stressed all the portfolios, and we came up with some really good answers for our clients. That's what we do. Now, to do that, you really have to have people that have had experience in the marketplace. I tease a lot of people that I'm the only person at BlackRock that has bought a long bond that has actually matured. So I've been here a long time. But we have a seasoned group of people, and part of it is the culture of attraction and retention of your people so that you have continuity in the marketplace, and maybe have seen this before, but you also have to consistently add new people in so you don't have group think and people that are looking at things in different ways. And to do that, we created our BlackRock Investment Institute. And we did that by bringing in different people with different skills to help us think through. So the research was to be used, not to pontificate. And they are part of helping the portfolio managers think through some very difficult scenarios. And then we test the portfolios. And every time we test it, we always got one pearl. We learned one thing that we maybe could do better, and then adjust the portfolio to do that. So it's having the people that have experience, making sure that it's not groupthink, making sure that you have a diverse group of people for a diverse thinking as well, making sure you spot the trends, and then having the analytics to use to put it all together to see what the expected results are going to be. And that's what we do. And, we do it differently because we're a fiduciary. And what that means is we don't manage money on behalf of ourselves. Everything we do is on behalf of the client. And because, as I mentioned to you before, that most of our clients are retirees in one way or another, failure is not an option here. So we take this very, very seriously, and we monitor the risk very, very closely to make sure that we're within the framework of what the client is expecting from us. And the reason we can be in business 34 years is we keep our promises to our clients. And if you do that, more people want to work with you and they want to invest more with you. And we need to continue to come up with ideas, different securities to make sure that we keep those promises.
In hearing you talk, we have the group here a little bit of inside. We're inside BlackRock right now. We can share. You and I happen to be sitting in the innovation hub, the iHub here in Atlanta, years ahead of its time, doing things the firm hasn't even thought about because it's really R&D. Represented, we have people from our LATAM business here in the iHub. We have our digital people here. We have family. We have all kinds of representation for them to connect. And what I thought was really interesting is, as a 2-decade BlackRock citizen, the balance of having deliberate focus on those trends with not being reactionary to the moment. And I think that's really been an amazing secret sauce for BlackRock, not only as employees, but obviously for our clients, because the first thing you said is we called our clients. And that analogy of the insurance company underwriting cars, I mean, that really brings it to life. If you go a step further, if you think about some of the conversations you're having, and we took a big step on this, let's talk a little bit about purpose. In volatile markets like these, people look to leaders across public and private sectors to deliver a clear purpose and a long-term view. What do you think about BlackRock's purpose, and more importantly, its purpose during times like this?
Well, certainly our mission is to provide a better financial future for our clients. And I think that is a very lofty goal because people have different interests, but this is the money that they work 30 years for. And they have aspirations to retire, spend money on college, create wealth for the next generation. And what's more important than that? So when someone entrusts you with their money, they're entrusting you in their dreams. And that's why I mentioned that failure is not an option here. So you can't treat things like a trade, or you can't discuss it's a basis point. Mm-hmm. It's real money to people. And it's the difference between going out on the Saturday night or not for many people. And for others, for corporations, the pension plans to help retain their employees. And then there's a higher purpose, is what are we doing all of this for? And so we asked companies what their purpose is. And we are invested in over 3,000 companies. And we want them to not only be thinking about the product that they have, but shouldn't they be thinking further as to what are they doing for their community and for the rest of the globe? And so Atlanta is an area that we wanted to build. And we're in an area that needed construction, and it needed to be reinvigorated. And we chose this area for that because we thought this would be a good thing for the Atlanta community. And then we chose it as an iHub, and it's not our only one, but it's our iHub to bring people in, to create ideas, and to populate those ideas in the portfolio. And so, in a sense, we have a mini BlackRock that's part of the whole operation. And it's very exciting to be bringing in people from different walks of life, different experiences, because isn't that what a portfolio is made of? Different companies, different products, different ideas. And since every company, every institution is going through some form of evolution and efficiency and technology and changing of people, shouldn't we be doing the same thing? So it's a more holistic way of thinking, and I think if you do that, you will become a better investor. And so that's why we've created the iHubs. We're very excited about it, but you still have to make sure that everyone in your company, in your business, all understands what the mission is of what we're trying to do. And then everyone plays a piece in making that mission happen.
Let's get into the core topic of today: democratization of investing. You can talk about this. We're going to take it globally, obviously, where it applies to LATAM. So, what trends are you seeing in the industry that's supporting this flow of democratization of investments? And the question here is, how is BlackRock leading the way? But maybe if you can capture a little bit of the steps of democratization that we've already kind of seen, and maybe that trend that you're seeing going forward.
Well, this is tough because I would tell you that one of the leading industries is technology. And around every company, around every community, around everything we do, there are borders. And within those borders, there are rules of engagement, right? Around your kid's school, there's a border and there's rules of engagement. Around in LATAM, pick any country, there's a border and there are rules within it. And we're dealing with a world where technology has no borders.
Mm-hmm.
So there are no common rules of engagement. And I know a lot of regulators would like to regulate, but how do you regulate something that goes through all the borders? So as this is happening, the globalization of the capital markets really made it, a great opportunity to really go out and to learn what's going on in different markets and different industries in different countries and create this theme that I described in the very beginning. But now that's all changed. And so what was happening in Russia and the Ukraine may cause the world of investing to change because we may be going from globalization to nationalization. And on top of that, the supply chains of where people are getting product from may also change because there are a lot of people that aren't happy about not being able to access what they want in their own country. So the cross-border trading may change. So we have to think about how that's going to fit into the future of how we invest across the globe. And I think that we got to all give some thought to this because it's going to impact every single group. And then the changes towards currencies and the introduction to crypto and the pay systems that are going to cross globally or nationally is also going to change. And then the type of investors are changing because more people have access to investing than ever before because of technology. And their opportunities for investing are going to be different than they were before. And we have to protect those investors from just trying to time the market and think that's the right way to invest. So there's a whole education and awareness process that has to go on. And I would say, in Latin America, it's also very interesting because not only do we deal with pension funds and institutions, but we deal with a lot of high net worth individuals who have done very, very well in a company that their whole family has been working on for years. And now they've created wealth. And while they are experts in that particular area, the success makes you think that you are now experts in investing across the globe. And
different education.
I've seen more high net worth individuals come in and at the first go of it, lose 20% of it because it was exciting investing in things, but it didn't all work out as well as that long-term business that had a great product that excelled and they did a great job. So then they come in and we start off at 101, diversification, different types of portfolios, what their risk might be versus what the rewards they want. And we create something that they will not have to worry about that hard-earned money for the future. That we can create a long-term investment vehicle, investment process to achieve those goals. And then, of course, you're successful. You should have a percentage of that to go around and enjoy and buy things and have fun. You earned it, or invest in other businesses that you want to do. But it's so important not to get over your skis, as they say, and just start buying stocks and bonds indiscriminately and think that everything is going up. And I don't say that in a humorous way, because what people in the market have to understand, we have gone through a 20-year bull market and interest rates have come down for 20 years. And if you invested in the stock market, it went up. And over the last many years, you buy the dip and it always goes up. I'm going to tell you, after over 35 years of experience, it doesn't always go up. And, different companies perform differently. Some of us can make mistakes in a company, overinvest, underinvest. Innovation takes you out of the market. There's disruptive innovation. There's ways to disintermediate people's businesses. So it is a real important thing to do, is to sit down with the family, determine what your expenses and others are you going to need, and make sure that you have that locked in for the next generation. You were lucky to have it in your generation. It's important to take it to the next generation. And these are some of the things that we like to do. And especially with our Latin America clients, I notice that this is one thing that is really important to them. Is why I highlight it. And we do this well as partners. And as a fiduciary, as I said, we sit on the same side of the table. So how can we get our clients an above average rate of return so that they can have a great financial future?
So we have, I know we're up on time. We have to do one last question because it ties perfectly to our first item and something you've weaved straight through. And I love the broader explanation of democratization, not just access, but education and awareness. I mean, it really has a multifaceted approach. The last question, culture. You are very much known as the heart of BlackRock. It's a word that many have received at BlackRock that you've underwritten. How have you helped with the founders keep the culture, bring it to the next generation of senior leadership, bring it through the entire organization, bring it for us with the responsibility to bring it to LATAM, what does that mean to you today, and then as you see it into the future?
Well, I think it's to be inclusive, to be transparent, and to help in people's career and to bring them along. So the greatest success the founding partners would have is to bring someone in from a school and watch them develop, give them content, and help them to be successful. And then eventually they tell my stories better than me, and my jokes better than I do. But
Maybe
I
the latter.
watch
Maybe the latter.
and I see them have that, that eye that they all want to learn. And I tell them, I describe it, the analogy I use is basketball, and that when they come in, they're at half court. And my job is to help them develop content and they get closer to the basket. Because if you're standing at half court, you're not going to catch many balls. But if I get you under the basket, there'll be a lot of opportunities that come. So what I try to do is put people in a position to be lucky. And the way you do that is content, and then the opportunity, the mentorship, and the culture of be nice. We're all working together as a team. And we hire a lot of people that come in and they're very ambitious, and that's okay. But we work together as a team and we compete externally, not internally. And I think this has worked well for us. It's a good recipe. We have a lot of very successful people like yourself that have done lots of different things. We're mobile, make sure that people can maybe live in different areas, work in different areas, and they're constantly learning. And then you look at them many years later and you say, I had a little part to play in that success. And that's what makes us feel good. And the last thing is you have to keep your promises to your employees, to your clients, and to your shareholders. And that's a full-time job.
You made the first part seem easy. We could go on for hours. No, thank you on behalf of all of us here in LATAM. And obviously the entire firm and our clients, appreciate the time and your insight. Look, thank all of you again for this session. Before we go to the next one, we're going to have a short video on democratizing investments and what it means for all of us.
Well, thank you very much, Ross and Rob. That was great. Some of the comments coming in for rocking it in Atlanta. Now we're back here in the studio in Mexico City, but I'm going to hand over to my tocayo, another Nicolas Gomez. Nicolas is head of ETF and index investments and product development for Latin America at BlackRock. Nicolas will be joined today by 4 other speakers from all across Latin America, and they'll be sharing a range of different insights with us here today. We have Alejandro Garcia, head of equities at Producción from Colombia. We have Renato Aid Tucci, head of index strategies and ESG integration at Itaú Asset Management. And we have Lucy Sommer, head of portfolio advisory group international at UBS. And finally, we have William Gambardella, head of global client and impact solutions at Morgan Stanley. Over the course of this next panel, we're going to be looking a bit more into ETFs and their ability to sort of innovate across the region. And for that, we're going to be listening to all these different experts. I'd like to remind everyone that we do have streams going out via Twitter Live, Facebook Live, and Twitch, and also some content that you can find on TikTok. This content where you can interact and enjoy the streams will be available today and also tomorrow. And as we said earlier today, we want you to concentrate on enjoying the content and enjoying the assets that are being shared with you on screen. All the materials, any presentations you may see will be provided to you afterwards by the team at BlackRock.
Very good, very good. Thank you, Nicholas. And we understand. These things happen when we're running a live event. So it's great to have this panel here with us today to discuss about ETF uses and adoption. But before we go into the great experiences of our panelists, I wanted to give a little bit of context about ETFs and the main drivers behind their rapid growth. So since we have a pretty large audience, I want to briefly describe what ETFs are. ETF stands for Exchange Traded Funds. They're baskets of stocks, bonds, or commodities in the form of a fund, but different from a mutual fund, it trades in an exchange like a stock, like a security, with intraday pricing and intraday liquidity. So a little bit of context about the asset management industry. The asset management industry is growing at about 4% per year. Now, ETFs, which are inside the asset management industry, are growing at 22% per year. And this is globally, and we're seeing the same in LATAM. In LATAM, about $225 to $250 billion of Latin American client assets are invested via ETFs. Basically, ETFs are the instruments of choice for LATAM investors to build international portfolios. So now, what are these main drivers for growth that we're seeing in the region? One, internationalization of portfolios. One driver particular to LATAM is this big trend towards international diversification, both in onshore portfolios as well as offshore portfolios. Offshore being those assets that are being moved and managed outside of our local countries and being managed mainly in the US for Latin American investors. Number two, ETF investors are active investors. Most portfolios are active portfolios. It's not about active versus index or active versus passive. It's about active portfolios using cheap, liquid, and efficient passive instruments like ETFs to implement active strategies. The third big trend is the transformation in the business model for financial advice. That is the trend of the business model in offshore wealth that is moving towards fee-based accounts from brokerage or transactional accounts. We're also starting to see this trend in other onshore markets in the region. And finally, the last big trend is ETFs as liquidity tools. Institutional investors using ETFs for the liquidity. This is across all asset classes, but this is particularly visible with fixed income ETFs, where ETFs improve significantly the liquidity of an asset. When you think about the spreads of an asset, think, for example, of high yield bonds that they trade at about 1% spread or 100 bips between bid and offer spread. When you look at an ETF, a high yield ETF like HYE, it trades with 1 bip of spread, 100 times smaller spread. So the idea here is for this panel to bring these trends to life, to bring these concepts to life as these investors share their experiences with you. Let's start with internationalization. So to start the topic of internationalization, so we estimate that about 10% of Latin American assets are invested abroad. That's up from 5% 8 years ago. And we estimate that for every $1 that is invested abroad, about 40 cents are invested via ETFs. With the Chilean, Colombian, and Mexican investors ahead in this internationalization journey, and more recently, with the Brazilian investors moving strongly into international assets over the past 2 years. So I want to start with my first question to Alejandro from Protección Pension Fund in Colombia. Alejandro, thank you very much. What percentage of your portfolio is invested abroad? And how do you think about the role of international diversification in your portfolio? And finally, if you can qualify and share with the audience why pension funds are heavy users of ETFs to access international markets. I think something like 50% of international portfolios with the Colombian pension funds are invested via ETFs. Alejandro, over to you.
Okay, hello. Thank you, Nico, for inviting me and letting me share a little bit of the experience that we have had in the last decade introducing ETFs as a tool for our investment process and our asset allocation process. To answer the first part of the question, we have 45% in international asset. It's mostly international equities, followed by private equity and fixed income. To talk about international diversification, I would like to talk first about how is our investment process. We are long-term investors. It is also very important for us to seek for absolute positive returns and real returns for our clients. So international diversification has been a very successful tool for us in the last decade to increase not only diversification to lower risk in our portfolios, but also a very important tool to increase higher returns in our portfolios. I will say that ETFs are the most important vehicle to invest in international assets for pension funds in Colombia. I think there's a broad range of reasons for that, but I will divide it in two groups. The first group of reasons is related to the asset allocation process. For example, diversification, it's not only how you lower your risk in your portfolio, but with ETFs, we have a wide variety of products to access to international markets. The second reason will be we are top-down asset allocators when it comes down to international assets. So for us, having ETFs is like having building blocks that allows us to have diversified portfolios using just a couple of instruments. And a third reason for that will be that for us, it's very important to have a strategic partner managing ETFs that allow us to focus in asset allocation, portfolio management, and risk management instead of allocating resources in security selection and trading. And the other reasons for pension funds to use ETFs are related to the advantages of the ETF itself. For example, cost, ETFs have low transaction costs and low expense ratios. Other reason is they are very easy to access for us. For us, 100% of the trading is electronically, so it's very transparent and very easy for us to set up a trade. Liquidity is, of course, one of the important reasons you use ETFs. And of course, scalability. It will be impossible for us to access international diversification across the world going directly to markets.
Thank you very much, Alejandro. Now let's go to Brazil.
Also a pleasure to promote debates like this. So as you said, we've been experimenting a fantastic journey when you think about investments here in Brazil. And mostly because it's a change in the way that we used to think about it, not just to look into a product or a single strategy, and also and have a short-term investment horizon, but how can I build a diversified portfolio that's aligned with my investment objective at the same time that I expand my investment horizon. So it's a really an exciting environmental here. So having said that, the same way that the client needs to think about the building block strategy to compound its portfolio, we as an asset manager in Brazil need to think about which classes, themes, geographies, and hence exposure that are lacking in our offer to support all this portfolio diversification. So in this context, we choose to expand our offer of international products in a very natural way. This is a very dynamic journey with a lot of learning because we tend to look at the results in their pieces and ignore the result of the portfolio. Another important aspect here is to start all this framework to understand how this kind of exposure will impact a portfolio. So whether in a broad-based index, thematic investment, DM, EM, it's very important to start and feel how the international exposure through the ETFs will compound the results and will impact the results of the portfolio. So, and it's quite interesting because so far this year, BRL has appreciated, give or take 20%, which has brought several questions about all this move to international exposure. But we can think that now this is gone just because of the level of the effects of this recent move. We need to stay and think about investment as a long term, as a strategy that I need to use all these building blocks that we are offering to our clients to compose and to compound our portfolios. So it's here to stay, definitely.
Thank you, Renato. Excellent. Let's now move to the offshore wealth market. That is assets from Latin American families managed mostly out of the US. So my next question is to Lucy. So by definition, most of the portfolios that are managed offshore, that are managed by you guys at UBS, are international by definition. Can you share with us how your business is growing and evolving as part of this internationalization trend that we're seeing in the region? And here internationalization means a little bit a different thing. It's more the context of assets that are moving from the onshore market, from the local markets, and to be managed offshore, to be managed outside of those markets, mostly in the US. Lucy, over to you. And also if you can talk a little bit about the main asset allocation, if you can generalize, of these international portfolios.
Well, thanks, Nicolas. Maybe let me start by saying, as asset allocators, we always advocate for diversification, right? And as this year maybe painfully reminded us, there will always be global systemic risk events that we'll be exposed to, and they're hard to kind of diversify away from. However, there are also local risk events, and as I'm sure many of the people in our audience will be aware of, many countries will actually hold elections, specifically in Latin America this year. And of course, those local risk events, they can potentially be mitigated by portfolio diversification. And also, I'd add many of our clients are entrepreneurs that actually have built their wealth by taking concentrated risk often in their home countries. So from that point of view, diversification, also in terms of asset location, is a great tool to reduce the impact of these local risk events, and also will help them to preserve the wealth that they've worked so hard for future generations. Therefore, we are actually indeed experiencing increased interest in international investments and international diversification away from home countries, and also the traditional home bias that we've experienced in many client portfolios. So maybe staying at that point and addressing your second question, of course, when we look at asset allocation, I'd say every portfolio is a function of the client's individual goals and needs. However, what I would say is that we do see a general trend moving away from specifically concentrated fixed income portfolios, and also a high allocation towards emerging market debt, rather towards more diversified portfolio. And we anticipate that trend to continue in the near future as well.
Excellent. Thank you very much. Let's move along. Let's move to the second big trend, and that is what I call ETF investors are active investors. We've seen in volatile markets that with ETF liquidity, intraday pricing, and low cost, an increased focus from investors on asset allocation versus security selection are some of the reasons why we're seeing more and more utilization of ETFs as building block for active strategies. I want to ask a question to William, to Billy from Morgan Stanley, and then to Alejandro and Renato to complement. But I want to ask you, Billy, how do you react to this statement? It's not active versus indexing, but it is about active with indexing, active with ETFs. And if you can share a little bit about how actively you trade ETFs in your portfolio in normal market environments, and also in moments of more stress and volatility, like the beginning of the pandemic or at the beginning of the war in Ukraine. Over to you, Billy.
Thank you, Nico. And I agree with you 100%. It is not active versus indexing or active versus passive, because simply by creating a portfolio and using the vehicles that are our ETFs, we're making active decisions, right? So from an asset allocation perspective, those are active bets. The vehicles we use are very, very efficient and low cost, and really allow us as a firm to capture the best thinking from an asset allocation perspective in a very, very efficient way. And if you look at academic research, it shows that asset allocation is going to be 80 to 85% of the portfolio's volatility of returns. So getting that part right, which is the active, and then using the low-cost options really does make for an efficient portfolio. We've seen incredible growth here at my firm with regards to that. And to build on what Lucy was saying before, we're seeing significant assets flow out of LATAM into the US for that financial stability, the options, and the liquidity, in addition to the regulatory requirements. So if you have a great financial system such as the US, combine that with UCITS ETFs, which have a lot of built-in protections for clients, it really does put a compelling option there. When it comes to trading, we built out a team of offshore traders that can handle ETFs, and we're seeing a significant amount of flows going across our desk that are more and more UCITS-based ETFs and ETFs in general. And that's important because we want to be able to trade in a normal environment where we just make our portfolio adjustments. But then more importantly, when there's times of stress, we want to be able to trade efficiently across those. And happy to say that we have not seen any difference with regards to the trading and the liquidity in normal times versus times of stress. So we change our portfolios on average 3 to 4 times per year on a tactical basis. And then when the market gives us an opportunity, such as in March of 2020 with the pandemic, we do accelerate that. So we did a couple of trades, and the ETF trading has been flawless in both scenarios.
Thank you, Billy. In the interest of time, I'm gonna move to the next big trend, which is very interesting, and I think it needs a little bit of an explanation, which is the transformation in the business model for financial advice. It's another big trend that we're seeing around the world, which is trend towards fee-based, driving anywhere between $500 billion a year to $1 trillion a year into ETFs in the US wealth market, with traction in Europe and with traction in the offshore wealth market for Latin American investors. So I wanted to ask Lucy, perhaps fee-based is not a term that everyone in the audience is familiar with. So I wanted to see if you could please explain it for this forum, talk about how it reduces conflicts of interest and how it aligns the interest of the client with the financial advisor. Over to you, Lucy. Sorry, I think we had a problem with Lucy, but maybe as he joins us back, maybe ask Billy, also in the offshore wealth market. Billy, can you talk a little bit about first the definition of fee-based and how is it different from other traditional models? And then talk a little bit about how the fee-based business is making ETFs be more important, or how ETFs fit into the fee-based model, and what's the role of ETF models in the fee-based portfolios?
Yeah, it's a great question, and one that's happening both on the onshore side and the offshore side, moving away from that commission-based. Think of it as more transactional, what's happening in the market right now, let's buy a stock or a bond, to more of a fiduciary role. And I think that's the biggest driver of that, is that advisors are becoming fiduciaries. And by that, I mean they're obligated to act in the client's best interest. And that's what you get with an ongoing fee-advised portfolio or account. And that is a trend that has been in the US happening over the last number of years, and now gaining a lot more traction with regards to LATAM and non-US. It really puts the advisor in a modern wealth scenario where they're giving the best advice at the current time, and that's ongoing. And that compares with the old brokerage model where everything was sort of in that moment and transactional, and then sort of revisited on a more longer term basis, say once a year. So we're seeing that because that's what clients want, and that's what we want to make sure that we give them. ETFs play a significant role with regards to that construction of the portfolio, because if you're doing an advisory asset allocation portfolio, the explosion in ETFs give us access to pretty much every area of the market. In addition, we can trade these portfolios on a timely basis, which benefits clients, but then also makes it very, very efficient and easily done at a firm such as ours.
Thank you very much, Billy. And moving on, we have about 4 minutes left. So I want to go through the last big trend in ETF growth and adoption. I want to talk about how investors are using ETFs as liquidity tools. So let's briefly talk about liquidity as that attribute. That is, it's we see it in all asset classes, but we particularly see it, as I mentioned, on fixed income ETFs, and the great improvement that you see with ETFs versus bonds that trade over the counter. So I want to ask my final question to Alejandro from Protección, a Colombian pension fund. We've seen pension funds in Peru, in Chile, in Colombia using fixed income ETFs for the first time over the past few years. We've also seen central banks using fixed income ETFs because of the liquidity profile to do very large trades. So Alejandro, I wanted to ask you about the case of Colombia. I see that trend happening through the region, but it has really accelerated in your country. So I wanted to ask you, how did Protección start using fixed income ETFs for the first time, and what is the role of fixed income ETFs in you guys' portfolios?
Sure. I think the benefits of using fixed income ETFs have been even greater for us than using equity ETFs. For us, we started using them a couple of years ago. It was an alternative for having exposure to credit spreads market. Before that, we just didn't have the opportunity to have a very active or a very tactical strategy in credit spreads. The alternative we had was to use single names. So it's what's incredibly hard for us to put together a basket, a diversified basket of single names. If you may know, the trading for single names is OTC markets. Those are thinly traded. Those are very liquid. They have very wide bid offer spreads. They lack transparency. So for us, it was a very big effort for our investment team, for our risk team to cover and analyze a big list of issuers that allow us to have a diversified basket, and to trade them, as I mentioned, it was even harder. So it allowed us to have a tactical strategy to focus on asset allocation, and we can have very large trades. So liquidity, as you mentioned, has been very important for us. It was an asset class in which we couldn't be tactical. We couldn't be neither strategic. So it was a breakthrough for us starting using those ETFs in our portfolios.
Excellent. Thank you, Alejandro. So with that, I want to end here. I really want to thank this panel, Alejandro, Renato, Billy, and Lucy. Thank you for a very interesting discussion, and to try to share your life experiences as investors using ETFs, and how these main trends that we're seeing, how do they apply to your portfolios, to your day-to-day. Thank you very much.
Thank you.
Thank you, guys.
Thank you.
Hello again. Nicholas here. Great to be back with you all after that short pause we took for several videos that we wanted to share with you from BlackRock. Now we are going to go live to New York, where we'll be partaking in a very interesting conversation. Calleja, head of Latin America for alternative specialists at BlackRock, and Valentine Edwards, Global Head of Real Assets within BlackRock Alternative Investors. Pleased to say, a fellow countryman of mine, Jim Barry, Chief Investment Officer of BlackRock Alternative Investors. Roque, the audience is all yours. Go on ahead.
Hello, everyone, and welcome to the last session of the day, where we're going to transition to speak about private markets. My name is Roque Calleja. I'm the head of alternatives specialist for Latin America at BlackRock, and I'm very delighted to introduce two very special guests today that are going to join me in my conversation. We have Jim Barry, our Global Chief Investment Officer for our alternatives investment platform, and we have Anne Valentine Andrews, our Global Head of our Real Assets team at BlackRock. So in the next 30 minutes, we want to discuss the state of the market in alternatives, but we also want to dig deeper into transition finance and the net zero economy and the path to a net zero economy. We want to understand what's the opportunity set, what it means for clients, and what should be our clients looking for when thinking about that transition to net zero. So let me start with the first question for you, Jim. And so we can put a little bit of context into a conversation. Let's discuss some of the new risks that we have seen that have emerged or that have accelerated in the last several months as a result of some of the unprecedented events that we have been seeing. The war in Ukraine, rising inflation and higher interest rates, some challenges around wage inflation and around supply chain challenges. So how are you seeing the world, Jim? Especially and more specifically, how are you seeing the world from a private market investor point of view?
Thanks, Roque, and it's great to be here with you today. Look, I mean, it is a very challenging time to be an investor in what is actually a very, very challenging time for the world. I think as we turn into this year, you touched on some of the issues that were, kind of facing us. The restart from the shutdown during the most intense phase of the pandemic was driving very significant supply side inflation. On top of that, governments were pulling back on the liquidity, and particularly the fiscal intervention was unwinding, all creating sort of macroeconomic challenges. And then the central banks really struggling with how to sort of avoid and prevent this supply-driven inflation feeding into a loop of sort of inflation expectation, and particularly driving the wages you touched about. And then we get Ukraine on top of it. The impact of Ukraine is enormous, and I think that as as Tom Donlan, our chairman of the Institute, describes the kinetic activity, the warfare itself is in a sort of a phase where it's a bit repetitive. The longer this goes on, the more significant the impact. And what it's done is, really exacerbate the inflation challenge. We see it in energy, particularly with natural gas and oil, but also food. And I'm going to come back to that because that's one of the greatest risks I see flowing from this conflict. But I think you've also got to overlay it with the scale of this conflict in a European context. It hasn't been seen since World War II. And there's a refugee crisis, 5 to 6 million refugees that are flowing into Central and Western Europe that will need to be dealt with. And so all of these challenges are very, very challenging for growth. And I think are going to make the central bank policymakers really struggle with the issues and challenges. Now, quite clearly, the market expects ECB not to be as aggressive as originally intended with sort of both monetary tightening and interest rate policy. The United States is still very hawkish, and the Fed is very hawkish on interest rates. But the real question now, to my mind, is Europe, without the growth buffer that the United States has, will it see, recession? And will the Fed policy, on the back of, again, the growth pressures, kind of exacerbate by Ukraine, tip the U.S. economy, which is much greater growth buffer, I would suggest, into recession. But back to Ukraine, it's not just an inflation issue, it's a security of supply issue around energy and around food. If I was to just use Germany today is talking about restricting demand on energy, industrial demand on energy. Couldn't even contemplate something like that even 2 months ago. So there are real issues there, but the one that worries me is food. Russia and Ukraine is not the breadbasket of the world as a description for no reason. It's a massive source of calories, particularly for emerging markets, particularly in grains and food oils. And that's massively disrupted now. And particularly in Ukraine, if we just take one example, 13% of the global corn harvest needs to be planted in the next 4 or 5 weeks. And it's not an issue of whether you're kind of the physical risk of planting in the West particularly, but who's going to invest the working capital in the crop without an expectation they might be able to realize that investment. And so that has massive implications globally, because if you can't get your calories from one source, you'll source them from another. And I think that pressure will play out particularly in emerging markets. And so just do not see a let up. And then we also have a problem with fertilizer. At the point in time we need Latin America, North America produce more food. We have huge challenges with potash supply out of Russia and Belarus, nitrogen costs going through the roof because it's flowing from natural gas. So we have a range of challenges. As a private market investor, I have an ability to think about how to play into those, certainly consider the resilience in the existing portfolio, certainly consider the resilience against some of these risks with new investment. But certainly, as I look at the longer term implications of these issues, whether it's deglobalization, which is get a huge boost from Ukraine on top of the general trend, whether it's the fact that the pandemic has not gone away and we still have to deal with it, and whether it's decarbonization, which is suddenly accelerated in Europe, maybe de-accelerated in North America, but certainly these are trends I'll play into as a private market investor as I consider the resilience of my existing portfolio.
Great, thank you, Jim. And anything you would like to add, taking into account you lead or
yeah, well, it sounds so doomy and gloomy when you put it like that, Jim.
My WhatsApp group at home is now called.
I can only imagine. Exactly. But thank you for having me here today, Rohi. This is great. From a real assets perspective, just to put that lens on it, the overarching themes have been hugely impactful, right? So we're talking about Ukraine, the energy security, the amount of energy that needs to be built in Europe, and also the US is obviously now a leading, energy provider, and moving away from Russia. That's a big new trend, but it's just an acceleration of what we were already seeing, right? So low interest rates, just the huge wall of capital that has moved into alternatives, and in particular into real assets in the last few years has been extraordinary, right? So think about 300 billion raised in infrastructure in the last few years. So everyone is looking for yield, and when you can't get it in interest rates, and so yield and returns is what investors are looking for. So you've got this huge search for yield, you've got the crisis that we're dealing with, and obviously the restart of the global economy coming out of COVID, which no one's talking about as much, but as Jim said, is still around. And then this huge move to net zero, right? And again, many years ago, we weren't really talking about this. We were thinking about it as investors, but the world hadn't woken up yet. So now the world is, how do we actually make this happen, right? All the pledges have been made, but we want to make this happen. So all of these trends are forcing huge investment into the net zero economy, which is what we're going to talk about today. But it's gotten real, right? It's practical now. It's real. It's not just people talking about it. And I credit Greta, I credit Larry Fink, and I also credit the Paris Accord, which was really a seminal moment. So thinking about all of these trends, it's tricky for us because we're long term, right? We're making decisions today that are going to have exits in 5, 10, 15, maybe never, right? We have lots of permanent capital as well. So what I think about is getting deployed into the right type of vehicles. So we have people all around the world. We can't do it from New York. We can't do it from London. Boots on the ground, understanding the local implications. And then when we buy assets, we asset manage them actively, and we run them for the long term. So, all of these things are interesting at the moment, but we're looking into the very long term trends and trying to see where that's going to go in 20 years with a crystal ball.
Thank you, Anne. So let's go into a little bit more depth around that path to net zero. And let me ask you, Jim, obviously that's a key focus for BlackRock, a key focus for your teams. What can you share with our audience around the size of the opportunity, what it means for private market investors, and also how will our clients capture that market opportunity set, and what are the different tools that they will have at their disposal for that?
So great question. Okay, I think, look, first of all, you've got to get your head around the scale of what's envisaged here. We're basically looking to undertake a transformation of the global economy of the scale of the Industrial Revolution, but in a third of the time. And so just no one cannot be thinking today, what does this mean for me and my investments? Not just from an opportunity, but also from a risk, because there's going to be winners and losers in this transition. And, you know, I heard a great story in December. It was a partner of one of the big global accounting firms. And the year earlier, he'd been invited to a client, a medium-sized building products cement company in Europe, family-owned, and asked to give a briefing on transition finance, on climate change and sustainability. And he said he was pretty much kicked out of the boardroom. This is not relevant to me. This is not relevant to our business. You know, this is all scaremongering. Go away. 2 weeks before I spoke to him last December, he got a call from the CEO of that company saying, we need you back. We're getting a call every day from our customers saying, what's our net zero strategy? And so I say, you know, as investors, we play into that. We play into it in terms of understanding where we have fossil exposure. What does that mean? And it's not a straight line, as we've seen with the need for to avoid creating the energy security issues we have in the short term as we transition away. But certainly, the challenge for everyone and for us as investors is that there's a degree of cohesion now around destination, most succinctly captured with the expression net zero by 2050, plus or minus 10 years, depending where you're talking to. But the pathway is still not clear, and it varies by country, it varies by region. And so that's challenging for policymakers, it's challenging for private actors, it's challenging for investors. And so I think that, you know, certain changes are there. Efficiency, there's going to be huge opportunities to invest in making our buildings more efficient, making our operations more efficient. That's easy. Electrify what we can. Mobility, you're seeing it. That's why the push on electric vehicles. Because why? Because we can decarbonize electricity production. We've got proven technologies that are cost effective even before you take in the recent price rises or the cost of carbon. But there's a whole raft of other challenges, industrial processes, more difficult transportation like aviation, where we just don't have the answers. We rely on hydrogen as an example. So these are things that require new technologies, new business models, new materials. And so as a private market investor, you get to play in this world across all the major food groups. You know, in real estate, huge opportunity around taking really good assets that are not fit for purpose in terms of efficiency, turning them into, you know, kind of, you know, the right standard of sustainability and efficiency for what customers want today, for what tenants want today. Infrastructure, and we'll talk about a transformation of the energy and power complex. But in credit, private equity, in every place, you're going to be able to play into this. And particularly in growth equity, there's going to be so much put into trying to come up with these new technologies, new materials, new business models. And I think, you know, kind of that's where BlackRock is taking a lead, Larry at the front, but you know, we're playing in with new products like decarbonization partners and growth equity, a partnership with Temasek. You know, but it's across the spectrum. And if you're not thinking about it, then you're not taking advantage of the opportunity, nor considering the risk appropriately.
Great. And let me ask you, and going into a little bit more depth around infrastructure, right? You lead a team that has been pioneers in energy transition investing for very long, right? Since 2011. Can you share with our audience, how have you seen that evolution? What is the team focusing on right now? How do you see the opportunity set? And anything you can share with us around that?
Yeah, and I like to say that we were doing renewables before it was cool, and that was Jim's lead back when.
So in 25 years to become trendy. Yeah.
Exactly, you got to just start, and then everyone catches up. But so we were doing it, and we've now got the leading renewables franchise because we started back then and have developed all that expertise and knowledge. And so, sort of stepping back, I'd say a couple of things. I'd say the industry's matured. In infrastructure as an industry has matured hugely during this time. And this ESG, and it was what you just said, ESG has become table stakes, right? So stepping back, 10 years ago, everyone had funds that did all sorts of different deals. They did all sorts of different risk return deals, and it was a bit of a mishmash, right? If you look at what's happened today, the industry has developed, and you can invest all along the risk return spectrum depending on what you want. So we have debt deals, we have core deals, we have core plus. So it's become a bit more like real estate. And so people are much more focused on risk return and what they're going to get. So secondly, the ESG, nobody cared really 10 years ago about ESG. And now the depth of not only understanding how you measure it and how you understand what your portfolio has, but how you're improving that is, again, table stakes, right? So we're at the forefront of thinking about that and also creating products that are ESG friendly. I'd even say 10 years ago, people saw ESG as a negative, right? If you wanted to have an ESG friendly product, it actually cost you. I think now the long-term implications of making decisions today are all coming home to roost. Everyone knows that if you have a burger at lunch and wine, it's not great. And that's people starting to think more about that in terms of the investments they make. So taking a big step back, talking about where we're investing again, it's this long-term thinking. We have something that we call the 3Ds. So, we want to invest against the mega trends. Where's the world moving? So we call them the 3Ds, which is easy to remember. Decarbonization, decentralization, and digitization. So I think decarbonization is obvious, right? That's actually decarbonizing and pulling things out of both the energy, but also, as Jim said, the built world, right? So it's more broad than just energy. Everyone's very focused on energy at the moment, but there's also manufacturing, there's agriculture, there's the buildings, there's everything. So that's all to come. So we're spending a lot of time on that. Renewables is kind of the easy thing now, right? We understand how to do that. So that's one big feature. Digitalization, we all know how much time we now spend and did spend on the internet. Like, my kids don't care about anything apart from Wi-Fi when we go anywhere. And that's all happening in the cloud, but it's driven by what's in the world: data centers, fiber, cell towers, right? And so that's all infrastructure that's investable and that we build. And everyone has a right to that, by the way. And so that's something I think after COVID we all expect. And so that's the last D is decentralization. This one's a little bit trickier, but it's moving assets closer to the end users, right? So we've got commercial industrial solar, we've got meters that we put actually in people's homes, and also with what's happened in Europe, right? It's a little bit of people onshoring and bringing things closer where they are. So that's the 3Ds. Again, we think very long term. I can't tell you exactly what's going to happen tomorrow or the next day, but we're investing into the future. And so these assets are going to become more valuable over time. We can't tell you exactly which day or which month, but over a long period. That's what we're doing.
Great. And across those 3Ds and bringing to life maybe some examples of things that we're looking at, some deals that we've done, what would you like to share with the audience?
Yeah, so deals are always fun. And if we're at one of our forums, we'd have pictures up or videos, which is always cool. Look, I think wind and solar we've obviously done a lot of. I think that's pretty known. But maybe I'll touch on a couple of other things that are more interesting. And Jim touched on this, the EV charging, right? We've made a number of investments into the charging stations, right, that people are going to plug their cars into. This is a huge effort in decarbonization, right? The more, again, the pickup in terms of how many people are going to drive electric vehicles and how quickly that's going to happen. Everyone knows it's increasing. Again, we can't tell exactly when, but it's a trend that is here. We've done investments in Australia. We've done a big one in Europe. We teamed up with all the big car manufacturers to do that. We've also done one here. So that's a big area very exciting area of investment. I mentioned the meters. If you can't measure something, you can't control it, you can't decrease it. Mm-hmm. So putting actually meters into people's homes to measure the electricity is another deal we've done. And the last one, this is kind of a cool one. It's carbon capture. And what is carbon capture, right? And thinking about net zero, we have to pull carbon out of the air, right? We've put too much carbon into the air. So the only way we get to net zero is to actually extract carbon. And direct air capture, which is just pulling carbon out of the air, is still not economical. But we're doing a project that is linked to a factory, which is a very heavy CO2 emitter. Mm-hmm. And what happens is you pull the carbon out, you put it into pipes and you sequester it, which is actually very old technology, mm-hmm. and you sequester it under the ground. And so we're building what's going to be the biggest carbon capture project in the world in Houston. So, just to give people a flavor of some of the deals that are out there at the moment and sort of the new era of infrastructure, not toll roads. This is where infrastructure's moved to.
Great, thank you. And let me ask you, Jim, and what role do you see LATAM playing in this transition finance and this path to net zero? What do you think are the key aspects for the region to be present in this transition?
Well, look, I mean, first of all, the region is very important in a global context. I go back to food. The region has a really important role to play in feeding the world. That's going to have to be looked at in the new sustainable context. And I think, for Latin America to play the role it has to play, it's very important that it's politically stable, economically stable. I look at things like the pandemic, the vaccination rates. I mean, there's a way we manage this pandemic. It's to be vaccinated, and then to mitigate the impact on the health of the more vulnerable in society. There's a lot more to be done there. There's a lot more to be done economically to build resilience and strength in Latin American economies. And clearly there's a broad range. We're very committed to the region, as you know, with specifically in infrastructure, and his teams in Mexico and Colombia. Actually, the last international trip before lockdown in February 2020, where I was in Bogota, Medellin, and Mexico City. But look, I think the reality is, deglobalization, I think, can be very good for Latin America. I think that the more near-shoring to the big markets, not least the United States, will provide opportunities for Mexico and other Latin American countries. I think that, the region has ability to use hydro, but also, use renewables to decarbonize. There's varying degrees of commitment to that across the continent, but, that has to be done. And I think that, the commodity boom that's going to flow from all of this, it will be good economically for the region. There's no question. Again, that has to be done on a more sustainable basis. I think standards ultimately of the end consumer will flow all the way through to the mines and the communities they impact to be done in the right way. We've seen plenty of examples not being done the right way. So I would say Latin America has this really critical, pivotal role to play. But it still has a lot of work to ensure it positions itself for that in the right way.
Great, Jim. And let me ask you one final question. I think we did cover some of the major concerns that we're hearing from our clients in the region, right? We spoke about wage inflation. We spoke about rising interest rates. We spoke about geopolitical risks. A question that we get asked all the time is around valuations and how private markets are going to be delivering returns going forward at these same levels, right? With some of the challenges that we have mentioned. So what are your views? How are your teams underwriting and taking into account these challenges when they're sourcing deals and structuring deals? Anything you would like to share?
So, I mean, there's a couple of sort of dimensions to that particular question. I think, look, and I have great fun with the liquid investors in BlackRock alternatives who are always giving out. So your marks aren't right, the market's moved, and so and I have fun with them. I think, look, first of all, private markets is different to public markets, okay, and so it does not have the volatility, but for very good reason. First of all, the mark is typically done on a quarterly basis rather than a minute by minute basis, and in addition to market multiples, when you do a proper valuation exercise, you're looking also at the merger or acquisition multiple for that asset. You're also looking at cash flows, essentially. And so market sentiment, which can move dramatically from period to period, is just one dimension. And so you historically have got a subdued volatility to private market or private equity marks. Now, I would say to you that a lot of the growth equity pricing will see your kind of reductions this year, inevitably, particularly those that are pre-positive cash flow. But the great thing about private markets is you have time to fix things. You have all sorts of levers to sort things out if you do have problems or challenges. And so you're not compelled, unless you're in financial distress, which every private market investor has always got top of mind. So you've time to restructure, you've time to refinance, you've time to reposition. You've got all these opportunities. If you've got debt, you have opportunities to give some flexibility to the equity owners, give them opportunities to cure. So there's all these tools you have in the private market box to work through challenges as you see it. And I would say to you, valuation specifically, entities like BlackRock and our peers have very robust, resilient, integral valuation policies that you can lean on and rely on. And just by their definition will not have the volatility of the public markets. And I think I would also point out that, we've got things like real estate and private equity as kind of very mature private market classes, infrastructure, getting there in terms of tenor. But these are 40, 50 years in existence as asset management classes. And they've proven themselves through the cycles, through the environments, through inflationary environments, through recessionary environments. And I think that will be no less this time. Now, the big challenge I would say to you as around your question is getting the deals. We've had, Anne touched on the scale of capital accumulation in infrastructure. It's the same across all categories of private markets. And so the hunt for assets is real. And so retaining discipline in that underwriting and pricing process when you acquire is absolutely critical. And so sourcing, frankly, is a much greater driver of alpha than it's always been a key factor, but it's a share of the alpha generation is much greater now. And so here at BlackRock, we've made a big point of obviously having the teams with the deep sector experience or the regional footprint that gives them the relationships to get access to deals, ideally off market. But we've also got a centralized capital market function where we have both the liquid and private working together, as we see companies now very much looking to the private markets and the liquid markets equally as options as they think about their funding solutions. And certainly we like that leverage that we get from the connectivity with the banks, the connectivity with the financial sponsors, and also with corporate centrally as we look to drive origination and sourcing. So we'll be talking about this, I would say to you, as a challenge from our clients in every forum. But certainly, I think private markets will prove themselves again to deliver for our clients, whether it's returns or income or the combination you're looking for.
Great. Thank you, Jim and Anne. That was very interesting. Looking forward to have you back in the region soon with our clients. We actually have some team members from Anne's team coming to the region in a few weeks, but we'd love to have you both on the ground. So thank you, everyone. Hopefully that was interesting and looking forward to see all of you soon in person.
Many thanks, Roque, Anne, and Jim. And before we go into our final sessions of the day, I just wanted to talk to the audience a bit about what we can expect tomorrow. We've had a very exciting day 2, but I'm looking forward to day 3. And before we chat to our next guest, Diego Mora, I'm just going to take you on a run through of what we can expect tomorrow morning. We'll be kicking off with new perspectives and trends on wealth markets with Federico Moncaliano and Martin Small, both from BlackRock. Federico is head of offshore wealth and head of strategy for Latin America at BlackRock, and Martin Small is head of US wealth advisory business at BlackRock. So we'll be kicking off our day with that tomorrow at 10 a.m. Eastern. Once we've spoken with Martin and Federico, on to our next block, and this is potentially one of the blocks that I'm most excited about, because we've got a real star. So if you're thinking of just joining us for one session tomorrow, I really recommend stopping in for Tech Disruptions, Endless Opportunities. Of course, I recommend you come to all our content, but this special session where we're having Dean, who is head of Aladdin product at BlackRock, but also Michio Kaku, who is a theoretical physicist, a best-selling author, and in his own words, a popularizer of. So we're talking about a real superstar here, a real academic, scientific superstar, and he's going to be enlightening us a bit on what we can expect in the future, what those disruptions can bring, how they can help communities, how they can help societies, and obviously that's something we're very interested in hearing here in Latin America. And before we finish off, tomorrow we will have Louise Cooperstrom, the Chief Strategy Officer from Betterfly, and she will be joined by Karina Saj from BlackRock. She's the country manager in Brazil. Now, I think they will confirm to me now my earpiece, but I think we're all set to go with our final guest of the day, Diego Mora. Diego, manager for Colombia, Peru, and Central America at BlackRock. Diego, it's good. Talked a bit last year. It's nice having you here on today and to be able to chat. I just wanted to sort of get your thoughts on what we've seen from the content today, and how would you wrap it up for the audience?
Thank you very much, Daniel, and thank you to all of our participants in our Latin America virtual forum today. With this, we're getting to the end of our second day for this Latin America virtual forum. We started the day with our president, Rob Capito, reflecting on a broad range of topics, from the trends we are hearing from our clients and how BlackRock has adapted to these needs and trends, to democratization of investment, to our focus on alternative investments, to the importance of purpose and culture to run a company efficiently. Then we switched gears to Nicolas Gomez and our panel of speakers, where they shared some interesting insights in how ETFs are reshaping the world of investing. We heard Alejandro from Protección talking about the reasons of why ETFs are the main tool they are using for international investment. Renato from Itaú on how ETFs help complement the offering to the client. Lucy from UBS talking about diversification from an asset location perspective. So talking about the offshoreization of wealth management we're seeing in the region. And then Billy from Morgan Stanley on the discussion around active with index. And lastly, in our last session, we heard Roque, Jim, and Anne bring to life the latest trends in alternative investments, the impact of the current events in private markets, and very interesting discussion around the transition to net zero and the opportunities that this transition represents for investors, from growth equity to renewable energies to carbon capture technologies. And infrastructure and alternatives is a topic very close to my heart. As many of you know, BlackRock has a large infrastructure platform in Colombia. And earlier this year, some of the institutions that are watching us today, the AFPs in Colombia, some insurance companies, and an endowment in Colombia, committed $650 million to our second infrastructure debt fund, making it the largest private fund ever raised in Colombia. And research has shown that poor infrastructure is one of the main obstacles for economic growth. And we have invested in 4 projects, generating over 8,000 jobs in the rural areas where these roads are being built. The sponsors of these projects are building safe homes for the families of these communities. And, since our clients are primarily pension funds, so while we are building roads and investing in communities, we're also helping to grow the retirement savings of millions of people in Colombia. So as you can see, very close to my heart. Before you go, 3 messages. 1, follow us on our social networks. Second, the most relevant pieces of this event will be shared by email and will also be available on our YouTube channel. And third, follow our podcast, El Encuentro, our podcast in Mexico, and The Bid, our global podcast. In The Bid, I strongly recommend actually a series of 3 episodes called The Real Leaders of Net Zero, in which Mark Whitman, our head of international and corporate strategy, interviews 3 CEOs of companies that are transforming their business in light of this transition and winning as they do it. Thank you so much for joining us today. We will see you tomorrow for our final day of your Latin America Virtual Forum. Thank you very much. Bye.
Thank you so much, Diego, and thanks to everyone at home, in the office, on the beach, wherever you may have joined us from today. We will be back tomorrow with our content, and as I mentioned before, world-class speakers. So I'm really looking forward to that. Hope you are too. From Mexico City, hasta mañana.
O que é diversificação internacional? Diversificar é escolher instrumentos financeiros com características diferentes que possam apresentar resultados diversos aos estímulos do mercado, com o intuito de reduzir de forma generalizada o risco dos portfólios de investimentos, uma vez que os resultados menos favoráveis de alguns ativos serão compensados com os mais favoráveis de outros. A diversificação internacional está dando um passo à frente através da incorporação não apenas de ativos com diferentes comportamentos, mas também de ativos baseados em diversos países, de forma que o leque de resultados seja abrangente. Por que diversificar? A combinação de ativos não correlacionados, ou seja, ativos com comportamentos não vinculados entre si, pode fornecer com o tempo um portfólio menos volátil e de menor risco. Além disso, uma estratégia de diversificação internacional pode oferecer fontes de retorno diferentes das obtidas nos investimentos locais, permitindo que o risco seja distribuído entre os mercados e também em empresas globais. Prever com certeza quais os tipos de ativos que terão os melhores retornos em cada período provou ser totalmente impossível. No entanto, um portfólio diversificado ameniza os picos do mercado, permitindo resultados mais estáveis. Além disso, a diversificação internacional pode permitir o acesso a fontes de retorno não presentes no mercado local, admitindo uma potencial captura de benefícios adicionais.